All right, so the housing market, guess what? It hits even more records for the past month of May. Can you believe it? It's just typical for what's going on in today's market. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism in real estate. Today is June the 23rd. Hope everyone is doing well. And first of all, if you've not checked this out yet, I've got a 5-video playlist on the channel here. It's about the top 10 reasons why we will have another housing crash and crisis. Please check it out. I think it's definitely worth the watch. You can stream through it pretty quick here. And to accompany that, if you want to download my, I guess you say, digital copy of the top 10 reasons why we'll have another housing crash and crisis, go to housingbubble2.com, put in your email, you can download it and have a good read at your leisure. So once again, thank you very much. All right, so interesting stuff happening right now in the marketplace, and I think we're seeing lots of activity, lots of changes. We're at, I think, an inflection point for a lot of things right now. And I mean, it's just one of those things where it's like rolling the dice. What's going to happen the next little while? Well, right now we got some opportunity knocking the door at this time. I do get lots of stuff, and right now I've got direct to seller and off market rental duplex in Tampa. Cash flows very well. I've got an off market 2-unit place in St. Pete's. We're grabbing a small multi-family. It's like 4+ units in the southeast part of Tampa. It's got great cash flow. So for more information, reach out to me, hit me up with an email, and I'll be able to connect with you and tell you more about these properties. Okay, so that's part of the housekeeping going on here. And listen, here's what I hear on a daily basis. And why I'm saying this is that I'm going to a lot of meetings. I'm meeting with a lot of people. I'm taking a lot of phone calls. I'm engaging a lot of stuff these days. And really, the consensus is that we are not at the market peak. We're almost like well beyond the market peak, right? Retail is still moving onward and upward, which is kind of funny and silly, but there are cracks in the marketplace, and people are starting to notice that. The true investors that are out there are watching their numbers, so they're being very careful on what they buy and how they buy, etc. There's more distressed property than being discussed. Everyone is pretty much on board with that. Then the banks are mobilizing. I've mentioned this a bit before, but I'm hearing this from multiple unrelated sources. What I mean by mobilizing is that they're getting real estate agents or getting securitization companies, whatever, to go out and inspect properties, do valuations to see if they're vacant, or like valuations for property value, inspecting them to see if they're vacant or occupied or in decent shape. So they're doing that because they're preparing for what's going to come, all right? And as I mentioned, this is coming from multiple unrelated sources, so people who are in my market, different markets across the country. This is sort of what we're hearing, and it's kind of like this, I guess you could say, underground bit of information that stuff's happening behind the scenes. So really, you know, the market's going to change, or things are going to change. Now, if I've spoken with you before, please reach out again. Okay, reconnect, book a call. We're at an inflection point. Things are changing in the marketplace. I've had a lot of calls with a lot of people who have subscribed my programs over the past few days, and they're like, you know, is it time now? We're ready to go, the whole bit. What should I do? So yeah, that, you know, it really is time, and to start to prepare for this and start to get your marketing moving. So just keep that all in mind. So reach out, reconnect, do what you got to do. Okay, guys. Now the news of the day is just kind of interesting. So I had my you know, we're going to talk about existing home sales report today, but a lot of stuff happened the past couple of days and even today. So really, this information is based on the fact that, you know, Fannie Mae and Freddie Mac, their stock values plummeted the most in 13 years after a Supreme Court ruling. So it came out today. So basically, Supreme Court justices threw out claims that the Federal Housing Finance Agency, so there was FHFA, exceeded its authority under federal law, effectively crippling key arguments of the GSE bulls and their decade-long quest to recover value in the two-penny stocks. So the court did leave some hope to investors, saying they might be able to win on some damages claims, and on a separate claim that so-called profit sweep was illegal because FHA director was unconstitutionally insulated from being fired by the president. So it's interesting. So the second part of the ruling could mean that President Biden could oust the FHFA director, Mark Calabria. So basically, you know, he's been an advocate for releasing mortgage giants out of the government control. So after the housing crisis, the Fannie and Freddie came under conservatorship, all right? And basically, there's always a period of time when they should, you know, get on their feet again and pop out of conservatorship, whatever you want to call it. And essentially, that's what Mark Calabria's been pushing for. But clearly, that's not on the, I guess you could say, the agenda of the current administration in the White House. So as you can see here with this next slide, shares dropped like 40% today. when that ruling came out. And funny enough, just before I record this video, I did go on the Newswire to check what's going on here. And basically, the expectation is that since the justice basically said, yeah, you can probably fire him, the fact that he's going to fire him, he's probably going to replace him today, but we don't know who that person's going to be. And basically, it says that, no one's clear who's going to take over, but FHFA has an important mission of oversight of Fannie and Freddie Mac as well as the Federal Home Loan Bank system. It's critical that the agency implement the administration's housing policies. As a result, in light of the Supreme Court's decision, the president is moving forward today to replace the current director with an appointee who reflects the administration's values. So ultimately, I think we're going to go back, back to the dark ages with FHFA and Fannie and Freddie. So this is no surprise. Realize that Fannie and Freddie guarantees about 11, half of the 11 trillion U.S. mortgage, volume out there. So that's pretty huge. So basically, essentially, I guess you could say that Calabria and the current administration don't see eye to eye, and this is what's going to happen. So how that's going to play out, who knows? Basically, I haven't given enough thought yet to figure out if this is going to hurt or help housing. I think it's going to hurt us in the long run, but that will be to be determined as time goes on here. All right. So, by the way, just some other information that came out to show you how crazy the market here is. BlackStone bets on soaring U.S. housing market with a $6 billion buyout. So basically, BlackStone, back in the last housing crisis, they became a massive investor, buying rental properties, the whole bit, creating different companies, etc. And they actually sold out a few years ago all their assets. Well, they're getting back into it right now. So basically, the buyout giant has made a significant bet on the country's booming housing market with a mega deal for a company that buys and leases single-family homes. So they're getting back into the residential real estate rental market, okay? The firm's real estate arm has agreed to acquire a majority stake in the Home Partners of America group in a deal that values that company at $6 billion. Based in Chicago, Home Partners of America owns over 17,000 homes across the U.S., offering rent-to-own programs for residents who will eventually want to buy a house. Now, this is significant because Blackstone grew, they sold out at a market peak. Now they're back in again. So what are they doing? They want to get back into this. They want to acquire more. I'm betting also that they want to ride this next rental wave. So rental rates are going up. All these hedge funds are increasing the rental, their lease prices, the whole bit. So they look at this as another opportunity. So they are investing $6 billion. Now, as a majority stake in that company, I don't know, what percentage of the company they're getting for $6 billion, but with over 17,000 homes, $6 billion. If you do the numbers, 17,000 and $6 billion, it's about $342,000 per home. So if you think about that, that's pretty high value on the home price. But that's just doing simple math. But the value is the recurring annual or monthly and annual returns on the lease prices and stuff like that. So that's how that kind of works out, as far as I'm concerned. So are they paying a premium for it? They might be. It doesn't mean that they're not going out and buying homes in the market. They're buying somebody who already owns these homes, and they're going to work through the rental appreciation. But I want to point something out here, which is interesting. So read where the arrow is. It says they offer rent-to-own programs for residents who eventually want to buy a house. So this is the thing. So what you're doing is you're taking people who maybe have been through a foreclosure process, don't have good credit, and what you're doing is you're giving them the American dream, saying, hey, you rent with us, we're going to credit you a certain amount of your rent towards your purchase price, which could be a future strike price down the road. They might even put down what's called like an option payment, like under a lease option or some sort of down payment that could be non-refundable. And after a period of time, if they don't strike and purchase that home, they can lose some of that money as a non-refundable sort of deposit. So just realize that these are type of programs that might be great on paper and I guess incent people to jump in. But when you actually take a look at how many people go through these programs and end up becoming homeowners, it's actually not very much at all. All right, most people who do lease options or do rent to owns, they do it because they got to get a place, they want a reasonable place, and they want security. But oftentimes they don't end up actually exercising that option to purchase the home. So keep that in mind, and that obviously benefits the homeowner or corporation or whoever owns the home, which can just do the same exercise over and over again. You see, so it's kind of a neat way of doing things. So again, Blackstone previously launched Invitation Homes, another rental company following 2008 housing collapse. The company raised $1.5 billion in IPO in 2017. and selling the rest of its stake for more than 1.7 billion 2 years later. So these guys, I think, had about 80,000 homes under Invitation Homes, and so they sold that, made great money, and now they're back into it with this acquisition of what they're doing with what's it called again? American Home Partners of America. So there you go. So they're back in business in the housing market that we're going to compete against. So wonderful news, right? Anyway, if you're not already a subscriber, if you would certainly help my channel grow and smash that subscribe button, I really appreciate that. And by the way, if you think you're a subscriber, could you just resubscribe and check it out for me? Because I've been losing lots of subscribers over the past little while, but I do want to say thank you to everyone who has subscribed, because I hit another milestone, finally got over the 25,000 subscriber count. So hopefully things will take off now, but it's been a long road to get there with respect to what's going on behind the scenes. So I certainly should have a lot more subscribers than I do, but that's the way it goes in this environment. All right. Anyway, read between the lines on that one. So anyway, guys, the key to today's discussion was existing home sales. So funny enough that, when I talk about, housing market having records, well, it seems like every month a new record is being set for something. So in this case, existing home sales actually experienced for May a slight decline with respect to the May volume. So this decrease has been, I guess, a fourth straight month now, according to National Association of Realtors, which you kind of go, what's the reason for that? Well, the reason for that is probably high prices and lack of inventory. So ultimately, in the end, home sales fell moderately in May and now approaching pre-pandemic activity, said Lawrence Yun, chief economist for NAR. Lack of inventory continues to be the overwhelming factor in holding back home sales, but falling affordability is simply squeezing some first-time home buyers out of the market, right? The median existing home price for all types in May was $350,300, up big time from the previous year. Every region registered price increases. This is a record high and marks 111 straight months of year-over-year gains since March 2012. So pretty significant, way home price have been increasing over the past, how many years? That's 111. It's probably what, it's almost 10 years, right? Think about it, right? Total housing inventory end of May was about 1.23 million units, up 7% from April's inventory. So we saw a little uptick there. Typically, homes remain in the market for 17 days. 89% of the homes sold in May were on the market for less than a month. So there's what we got going on with respect to NAR's information. Now, NAR produces a nice visual graphic, which we're going to go through right now. That way it helps things explain a little better what's happening in the marketplace. Let me hit that. Okay, so obviously we talk about existing home sales, and you'll hear that NAR likes, and the economists, whatever, they like to talk about SAR, seasonally adjusted annual rate. So basically they look at and they go on May's activity. If you annualize that, we're at 5.8 million homes to be sold for the year. All right, you can see how it's the line changes. It obviously dipped big time when Corona was here, and it popped back up later, and then when everything was kicking up again back in the fall. But we're kind of down to that sort of 5.86 million range, which typically is what we normally have done for the past couple of years. So in the end, when it all normalizes out, sales are pretty much on par with what they normally are. All right. Now, the median price of existing homes, it said, reaching a new high. So the median price is a new high, $350,300. So you can see that's been basically moving its way all the way up over the past number of years. So that's happening. Existing home sale price percent year-over-year change. So clearly, the year-over-year change, is what, 23.6% for the home sales price, the median price. Now, there's a reason for that. Maybe because it was lower last year, right? Who knows? Did COVID affect sales in May? It probably did. But ultimately, price points are still accelerating, and that's the way it goes. If you take a look at this next slide here, the existing home sales percent year-over-year change. So our sales are up 44.6% year-over-year compared to this time last year. This time last year, if you look, which is basically the first part of the bar graph there, we lost almost 26% of year-over-year sales back in May, because that's, we were right in COVID. People were not going out. Deals were being canceled. People weren't buying the whole bit. So when we're up 44%, but you're comparing to the previous year where we were down 26%. So in the end, what's the normalization rate here? I mean, maybe we're sort of, back on track, mid-20s, right, so to speak. But again, we have to take everything in consideration with what was happening the previous year. So that's where we are. Realtor confidence survey. Now this is important on how I look at things. So first-time home buyers, 31% of the sales. Sales to investors, 17%. Cash sales were up 23% compared to the previous year. Days in the market, you can see, are getting worse and worse. So as opposed to 26 days in the market the previous year, down to 17 days in the market. And distressed sales, again, which were 3% of the overall market last year, only 1% this year. Distress, and you know I focus on this, distressed sales basically are short sales that occur in the MLS, which they have to, and they are foreclosed / bank-owned REO sales that are on the MLS. So basically 1% is those two components, which if you just want to be, doing some simple math, short sales or make up 0.5% of all the sales across the board. We can verify that when we look at different metro locations. So that's my point going, no one's focusing on that. That's where we have to focus. That's where the big opportunities are here. So I've said this every month, all right? Existing home sales by region, obviously the South, we have a lot more sales going on here, 45%. Midwest, 23%. The West, 20%. The Northeast at 12%. Northeast will typically pick up pace as summer months come, as they come out of the winter months for sure. Housing supply at a national level, so you can see that housing supply basically hit a low earlier in the year. It's gone up a little bit, but it's pretty much plateaued the past little while. So you've got essentially the condo supply is a bit more than the single family supply, which blends with the national supply. So it's pretty much been pretty much the same over the past couple months here. So no huge amount of things are coming on the marketplace. Sales by price range. If we take a look at what's going on, so starting off at the blue on the top, going clockwise, 0 to 100K was only 5% of the marketplace. Not very many homes sold for below 100K. The 100 to 250K, which I really sort of call affordable housing market, was only 26% of all the sales across the board. The majority happened in the 250K to the 500K range, price point 42%. But here's where we see some changes now. That 500K to 750K is 15%. The 750 to 1 million is 6%, and the 1 million plus is 6%. So we're seeing actually the growth above 500K is actually becoming a larger share now of the housing market for various reasons. If we take a look at the percent changes by segment, we can see that the 0 to 100K actually selling less homes they were last year. The 100 to 250K range selling less homes they were last year. 250K to 500K range, which basically is not a little more than affordable housing, almost up 50%, 47.9. But when you start taking a look at the higher end homes, 500K to 750, over 121% annual change. 750 to 1 million, almost 178% year-over-year change. And look at the 1 million and above, 244.5% year-over-year change on housing sales activity for this month compared to last year in that 1 million plus segment. So people really, either there's good deals or they're transferring wealth, moving from one place to the other, but that seems to be, that's the, I guess you could say, the segment that's growing. So even though, when you take a look at it, going back to that pie chart, when you take a look at how that pie chart sort of, rolls out here, it's clear that, it's still, the higher end homes, we got 15%, 6 and 6. So we got 21, we got 20. So 27% of the market is 500K and above, and that's actually much larger than the past few months. So I look at it going, how is it going to roll out here? Well, clearly, if more of the market share is actually being consumed by the higher end prices, then that's going to drag up the median house price as well too. So we're having less sales in the sub 250, but greater sales in above 250, and that's pushing the median price up for sure. So that's how that kind of works out, obviously. Interesting to note here, median days on market on homes sold in May 2021. So 0 to 100K was 19 days on market. The affordable housing, 100 to 250K, 6. 250 to 500K, 6 days. 500K to 750, 7. 750, 1 million, 8 days on market. 1 million above, 11 days on market. So think about that. You have a property that's worth over $1 million. You put it on the market, and on average, you're getting that home under contract in 11 days. Okay, think about that. That's huge. So stuff is really moving out there, and there's obviously specific reasons why people are targeting that price segment. All right. Sorry, I was a little too quick there. Month supply. If you look at the existing single-family homes May 2021, we basically see it's about projected a 2.4 months supply. So we've actually increased. We had our low month supply in February of 2.0, so just 2 months. We've increased by 4/10, of a month, I guess you could say. So what does the month supply mean? It basically equates to the fact that if no new listings came on the market, so if today no new listings came on the market, it would take 2.4 months at the way sales are pacing through the system to actually deplete the entire real estate available stock that's out there. So that's what we got at 2.4 months. So again, slight increase, nothing huge as of yet. Now, NAR also produced something that I thought was interesting, and this really was a vacation home sales. So they did some summary for the year 2020, and basically, so they said vacation home sales skyrocketed as a result of the pandemic, which seems to make sense. Basically, in 2020, vacation home sales rose 16.4%, outpacing the growth in total existing home sales of 5.6%. So vacation homes were the winner for last year. In 2020, the median existing home sales price typically rose by 14.2% in vacation home counties compared to 10.1% in non-vacation home counties. And in 2020, the top 10 vacation home counties were in the states of Florida, Maryland, Massachusetts, Michigan, and North Carolina. So that's where actually all the that's where the majority of the deals were taking place for various reasons. So you can read the report. I'll put the link to it. I mean, it just talks about locations, etc. But what it boils down to is the fact that the report found that the top 10 counties that were selling vacation homes, second homes, and let's step back here. What's the reason for that? Well, maybe people thought, well, you know what, I need a backup plan. Like, who knows where they were from when they're buying their vacation home? So this could be a preemptive strike to say, hey, I need to get something now. So number one, I can either, spend time someplace else, work there, live there, et cetera, et cetera. Who knows what it is? Or it's the fact that we're going to establish a residency domicile someplace else. So we've got a place and we're secure, and then we're going to sell where our original primary home. So who knows exactly what's happening? But the report found the top 10 counties were Lee County in Florida. Now, Lee County, for those who don't know, is the Fort Myers area. Okay, Lee County, Fort Myers, Cape Coral, Oscoda County, Michigan, Swain County, North Carolina, Collier County, Florida. Now, Collier County is actually just south of Lee County. Of note, you got Bonita Springs and you've got Naples. That's Collier County, essentially. Dukes County, Massachusetts, Allegheny County, North Carolina, Garrett County, Maryland, Barnstable County, Massachusetts, Alcona County, Michigan, and Macon County, North Carolina. So that's your top 10 counties that we're actually seeing major increase in vacation home purchases. So just something to keep in mind. Now, obviously, Lee County and Collier County I'm very familiar with. We spent a lot of time down there, done lots of deals down there. It's nice, and those locations are a little bit farther south than I am. I look at Sarasota, kind of the demarcation point. In the wintertime, you get a little more warmer weather below Sarasota. And again, I also want to make a comment that the west coast of Florida, so the Gulf side, is typically significantly cheaper than the east coast. So if you go to Lauderdale, West Palm, Miami, you're paying a lot more on average than you are for homes on this side of the Gulf. So there you go. All right, guys. So that's interesting. We're also with some more records. Usually if you wait a day, I'm learning actually now to not jump on the news right away when something's released, because typically something else follows it. So U.S. new home sales unexpectedly plunge in May to the lowest level in a year. So funny enough that we're seeing a decline in the overall volume of sales in existing homes, but we see a price point increase. Same thing here. So new home sales plunged unexpectedly in May. So ultimately, analysts expected May new home sales to rebound very modestly from the 5.9% plunge in April, but they were wildly wrong. So new home sales plunged 5.9% month over month in May, and April's crash was revised even lower at 7.8% month over month. Now, something about the new home sales reporting methodology is that we're going to hear stuff, and then the next month they always go back and they revise the previous month. So it's kind of a moving target, but ultimately, as they said, so April's was revised even lower. So it's we're trending down for sure, as you can see by the graph here. Now, unexpected drop pushed the seasonal annual adjusted sales to basically go at 769,000 units for the year against expectations of 865,000, the lowest since May 2020. So these new sales are dropping for various reasons, and ultimately it's going to affect the market for new home sales, new builders, but as far as overall inventory is concerned as well too. So interesting enough, when you take a look at this, the median home sale price, median new home sale price was up 18.1% year over year to 374,400. So another record here. So and the blame, is being, well, so that volume, that dollar value is being blamed for the drop in sales because of the affordability issue. So ultimately, in the end, we just see the stuff getting pushed and pushed and pushed up, which is, great if you're a builder. Clearly, price points were up. Why were price points up? Well, if we drill down, how far are we drilling down? Is it because lumber prices were up, because other materials were up, because of lack of inventory? So labor prices, entitlement price cost the whole bit. So we just basically look at, housing is going through an inflationary time period right now, and ultimately, in the end, it's the end user, the actual owner, occupant, buyer, or investor that's going to pay for it. So it's actually becoming a little bit out of control as far as I'm concerned. Clearly we want to buy cheaper homes, simple as that, right? And it's interesting because if you take a look at that bottom graph, which basically is sentiment. So essentially, none of this should come as any surprise given that total collapse in home buyer sentiment, and did the home builder sentiment actually count for anything. So home builder sentiment has gone up because they're probably thinking, hey, we've got this captive audience market and we can charge huge prices. But home buyer sentiment, and this is home buyer sentiment, which basically could be existing home buyers and new home buying, but you can see how that's plunged. So home buying sentiment is at the lowest it's been for a significant amount of time here, and clearly there's a big divergence between the two. So how that plays out, I don't know, but it's going to affect sales, which that's the first part, right? So sales get affected. Will we see some price decreases in new home sales? Possibly, because the lumber future prices have dropped, but how long that takes to reflect into the actual price points on what's being offered now, I'm not too sure how that rolls up. But if you think about it, new home sale is, you do a contract today for a home to be built over the next, say, 6-9 months. You should start seeing some of the effects of lower lumber future pricing, now on the price points they're offering for completions down the road. You would think that's what would happen, but we will find out. All right. Florida, place to buy and invest. Clearly, this is where the single-family rental companies are buying their properties in Georgia, Florida, Arizona, Nevada, North Carolina, Tennessee, Texas, Indiana, South Carolina, Ohio. A lot of these locations had major cities that had major issues during the last housing crisis, so it should come to no surprise that these are where people, primarily housing corporations, big, large investors, are buying their properties. So I say to you guys, it's like if you want to purchase property to live in or to invest in, Florida's the place to be. This is the MSA for Tampa, St. Petersburg, Clearwater area. You can see that the median sales price for which was April here, which is the MSA's data that I have the most recent of, 315,000. You can take a look at a short sale average was 245,000, and you look at the 70,000 in equity. That's huge. Just remind me I need to get back to somebody who reached out to me. So funny how these things pop up. So that's a discount over retail. So these are the reasons why you want to get into distressed housing. These are the reasons why you want to get into short sales and things like that, because there's actual deals to be had there. But the key, though, is that these aren't just floating around the surface like people. You'll email me and say, hey, Randy, find me a good short sale deal. It doesn't work that way, okay? If short sales were available on the market, we would already be doing them and already be buying them, and etc. These are the few people that have popped into the market that have had short sales done. The majority of people that need short sales are not on the market. They're sitting in their home wondering what to do. Thus, the difficulty in getting a hold of them. That's part of the process and part of the training which I provide. Anyway, so having said all that, this is the reason why you want to jump in and connect with me, just because the market is changing. We see it now. The discussions I'm having with all sorts of people who know a lot more than I do and are way more successful and got lots and lots of properties. They're already checking the stuff out, and we're engaging on different fronts here. So I've got the Short Sale Cash Connection, which talks everything about short sales you want to know, which is fabulous. Help you do that. Reach out for me on that. And then if that's not for you, I've got another program called Zombie Foreclosure Flip, which you could jump into, which is more entry level. And having said that, I'll tell you how to engage the distressed housing market. Just connect with me, Randy at Luxury Short Sales, and we'll go from there. But also, if you haven't done this yet, you want to know what's going on in your location, your neck of the woods, go to gethousingdata.com. That's gethousingdata.com. That basically is my partnership with Foreclosure.com. It's a very inexpensive way for you to check out what's happening in your location, i.e. what's in pre-foreclosure, what's going to foreclosure auction, what's going to tax deed auctions, what else is happening with probates or other off-market homes. You want to check this stuff out because most of this stuff is off-market, all right, and that's where the deals are. So check this out, gethousingdata.com. Very inexpensive to actually look at some data that's in your area. So anyway, appreciate the views, likes, comments. Please share the video with your family and friends. Not a subscriber, please subscribe. Reach out to me for anything, and we'll arrange. If we've not connected, let's try to reconnect. Lots on the go these days. You don't want to miss out. So having said that, everybody have a great week. We'll look forward to speaking with you before week's end. See you later.